Hello there, MSL here, and welcome to this IFRS summary video on IAS 10 events after the reporting period, which contains requirements for when events after the end of the reporting period should be adjusted for in the financial statements, as well as also providing us with some additional disclosure requirements. So a brief history of the standard. This standard dates all the way back to 1977 through to December 2003 when the revised version of the standard was issued. And then in September 2007, the name of the standard was changed to what we have currently. So as a standard, IAS 10 event after the reporting period was reissued in December 2003, and it applies to annual reporting periods beginning on or after 1st January 2005. So let's look at some key definitions within the standard. The first is, how does the standard define events after the reporting period? So the standard says events after the reporting period will be any event, whether favorable or unfavorable, that occurs between the end of the reporting period and the date when the financial statements are authorized for issue. So based on this, there are two main types of events. We have adjusting events and we have non-adjusting events. Adjusting events are those events that provide evidence of conditions that existed at the end of the reporting period, and non-adjusting events are those that are indicative of conditions that arose after the reporting period. And take note here that events after the reporting period will include all events up to the date when the financial statements are authorized for issue, even if those events occur after the public announcement of profit or of other selected financial information. So now that we know this, let's look into details at adjusting events after the reporting period. IAS 10 provides that an entity shall adjust the amount recognized in its financial statements to reflect adjusting events after the reporting period. Let me give you some examples of adjusting events as provided by the standard. Take note that this is just indicative, it's not an exhaustive list. The first will be the settlement after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. In this case, the entity will adjust any previously recognized provision related to this court case in accordance with IAS 37, provisions, contingent liabilities, and contingent assets, or they will recognize a new provision. The next example will be the receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period, or that the amount of a previously recognized impairment loss for that asset needs to be adjusted. An example or two could be where the bankruptcy of a customer occurs after the reporting period, and this will usually confirm that the customer was credit impaired at the end of the reporting period. Another example here could be the sale of inventories after the reporting period that may give evidence about their net realizable value at the end of the reporting period. Another example of a potential adjusting event will be the determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the end of the reporting period. Also, the determination after the reporting period of the amount of profit sharing or bonus payment if the entity had a present legal or constructive obligation at the end of the reporting period to make such payment as a result of events before that date. This will be dealt with into a lot more detail under IAS 19 employee benefit. Final example I'll give you here is the discovery of fraud or error that shows that the financial statements are incorrect. So these will be it for adjusting events after the reporting period. Let's now look at the non-adjusting events after the reporting period. So for non-adjusting events after the reporting period, what IAS 10 says is that an entity shall not adjust the amount recognized in its financial statements to reflect non-adjusting events after the reporting period. And take note here that the standard is clear that you will not adjust such events, but we need to know what some examples would be. So here, an example of a non-adjusting event after the reporting period is a decline in fair value of investment between the end of the reporting period and the date when the financial statements are authorized for issue. The decline in fair value does not normally relate to the condition of the investment at the end of the reporting period, but will usually reflect circumstances that have arisen subsequently. Therefore, an entity does not adjust the amounts recognized in its financial statements for the investment. Similarly, the entity does not update the amounts disclosed for the investment as at the end of the reporting period, although it may need to give additional disclosures under the standard. Now let's look at dividends and going concern as provided for under IAS 10. So with respect to dividends, the standard is clear. If an entity declares dividends to holders of equity instruments after the reporting period, the entity shall not recognize those dividends as a liability at the end of the reporting period. And take note here, if dividends are declared after the reporting period, but before the financial statements are authorized for issue, the dividends are not recognized as a liability at the end of the reporting period because no obligation exists as at that particular time. Such dividends, however, will be disclosed in the notes in accordance with IAS 1, presentation of financial statements. What does IAS 10 say about going concern? The standard provides that an entity shall not prepare its financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease trading, or that it has no realistic alternative but to do so. So take note, this is what the standard says about the going concern assumption. Obviously, this will have some link to the framework for financial reporting and IAS 1, presentation of financial statements. Now let's move to something that is perhaps the most important part of IAS 10, which is the disclosure requirements. The standard gives us quite a comprehensive list of things that must be disclosed, and you need to be really conversant with these. These are things you must know. The first disclosure requirement will be around the date of authorization for issue. So the standard provides that an entity shall disclose the date when the financial statements were authorized for issue and who gave that authorization. Also, if the entity's owners or others have the power to amend the financial statements after issue, then the entity should also disclose this fact. Here, it's important for users to know when the financial statements were authorized for issue because the financial statements do not reflect events after that particular date. The next disclosure requirement will have to do with updating disclosure about conditions at the end of the reporting period. So in this case, if an entity receives information after the reporting period about conditions that existed at the end of the reporting period, then the entity shall update disclosures that relate to those conditions, and this must be in light of the new information that they received. And then finally, to perhaps the most important disclosure of all the disclosures we've spoken about so far, disclosures that relate to non-adjusting events after the reporting period. So the standard provides that if non-adjusting events after the reporting period are material, then non-disclosure could influence the economic decisions that users make on the basis of the financial statements. Accordingly, an entity shall disclose two main categories of disclosures when it comes to non-adjusting events after the reporting period. The first disclosure will be on the nature of the event. The second disclosure will be to give an estimate of the financial effect, or if you cannot give the financial effects estimate, then give a statement or make a statement to the effect that such an estimate cannot be made. Let me give you an example, a couple of examples actually, of some non-adjusting events that will require disclosure as provided for under IAS 10. The first example of an event will be a major business combination after the reporting period, which will typically be under IFRS 3 business combinations, and these will also include cases where a major subsidiary is disposed of. The next example will be where an entity announces a plan to discontinue an operation. Also, another example would be major purchases of assets, classification of assets as held for sale in accordance with IFRS 5, non-current assets held for sale and discontinued operations, other disposals of assets, or expropriation of major assets by government. The next example will be the destruction of a major production plant by a fire after the reporting period. Another example also would be announcing or commencing the implementation of a major restructuring. This will fall under some provisions of IAS 37, provisions, contingent liabilities, and contingent assets. Another example will be major ordinary share transactions and potential ordinary share transactions after the reporting period. This will typically fall under IAS 33, earnings per share, and its relevant disclosure requirements. Another example that must be disclosed of an event would be abnormally large changes after the reporting period in asset prices or foreign exchange rates. Also, changes in tax rates or tax laws enacted or announced after the reporting period that have a significant effect on current and deferred tax assets and liabilities as prescribed under IAS 12 income taxes will also have to be disclosed. Then also entering into significant commitments or contingent liabilities, for example, by issuing significant guarantees would also have to be disclosed if these occur after the reporting period. And finally, commencing major litigation arising solely out of events that occurred after the reporting period would also have to be disclosed. So these are the key provisions under IAS 10 events after the reporting period. If you love this video, as usual, please don't forget to smash that like button and don't forget to share this video within your entire network. I will catch you in the next IFRS summary video.